Are the bears back? This is the question that everybody's asking, like you and I right now, when it comes to trading and investing. And the Fed's reality of an inflation fight is still ongoing, with big yield moves over the last 24 hours. But on top of that, we've got the Mag 7 becoming one of the most crowded trades, Lyft stock going bonkers after hours as AI takes over with the typo, and the biggest level getting reached on the S&P 500. Are the bulls still in control, or are those bears now in it? Nvidia holds, big moves on yields look to be getting worse, and the VIX finally spikes above 16, forcing hedgers to get involved. That and more coming up in today's show as we cover stocks, commodities, and cryptos together. Well, welcome back everyone to the Daily Show, where we discuss the macro lead indicators and the hottest charts together. My name's Tom, but let's get into it straight away because it was a sea of red across the board, led by the inflation results. As soon as they came out, markets tanked and they opened up with a huge gap that we'll talk about later on in today's video. But really, it was sticky inflation that was the problem. Rent has now been up at least 0.4% for 29 consecutive months. And it's this type of sticky inflation that has the market worried, along with, of course, a worrying trend of inflation going back up and not down like they expected. This could mean higher for longer, and you can see that yields have already made some massive adjustments over the last 24 hours. On the 12th of February, we were looking at this orange line, and last year we were looking at even lower and more rate cuts on the horizon. Now suddenly it's less rate cuts, higher for longer, and the end terminal rate is looking at around 4%. So nowhere near as many cuts as we initially hoped for, or at least traders had been looking at. So why is this so important? Well, it just so happens to occur in the week of OPEX. And as we mentioned, this week is options expiration, VIXpiration coming in 24 hours. And we are here, the point where we tend to see pretty big shifts. So a seasonality trend could be occurring here, and that could mean that there is a bigger pullback coming than usually what we've had through this rally, which has been small pullbacks in time and relatively small pullbacks in general. This Friday will be worth watching, as it does tend to have a negative correlation with it. And of course, the weeks after OPEX week in February have generally tended to be negative overall for the S&P 500 and Dow Jones. So what about an investor? If you're an investor in these markets, do you need to be terrified of a pullback? In general, no, because we took 5,000. And as we know, when we take a big 1K number, that does show strength for the market. In fact, 6-month returns, although we only have 5 reads, have been 100% positive over that point. Friday will be worth watching since the October rally. We haven't really had too many big negative Fridays. So you can see here the average is actually positive. So if you were looking at it, you would think, well, maybe this Friday will tell us a bit about what type of market we're in. A pullback market or a market that's still very bullish, and this little pullback that we've got so far could be all we get. Why could it be all we get? Well, accelerating global growth is generally good for equities. Of course, if the Fed has to hold rates higher for longer, it still could be a big issue across the board. But do remember that when we have these types of stats, that's what's leading into this earnings season and why we're getting these markets rallying through this point. In essence, they're actually meeting the expectations. But do remember the expectations for the next earnings are ridiculous. And in many ways, that's going to be the biggest problem. Could they even live up to it? And if the Mag 6 in particular didn't, can you imagine what would go on? Nvidia coming next week as well. If that doesn't hit expectations, it's a stock that you will want to be watching. I expect some extreme volatility around that particular stock. The rate that the cuts actually happen will also be important. I think this is worth screenshotting and make sure you have that ready when it does eventually come. As if the Fed does end up doing a fast rate cycle, let's say they hold for longer, then they start cutting, they break something so they have to cut faster, that will not necessarily be strong for equities. So do remember, we want a slow cycle, we want less rate cuts and more stable rate cuts, because that tends to mean the growth is still there underneath the hood. What about the Russell 2K versus S&P 500? Well, we've talked about how the smaller stocks haven't been doing very well recently, and they're trading at a massive discount. They're trading at even a more discount than the previous 24-hour period because, of course, we saw yields break through. And unfortunately, there may be a little bit worse to come for yields before we see some relief. But do we think that the 493 other stocks outside the Mag 7 and the Russell 2K will give better returns over the next 12 months? It does look like that way. as long as we see yields turn back down. And yields and those are very harmoniously synergized. Check out our X account, links in the description down below, for a chart that we're going to share on that a little bit later on. I think you'll find it quite interesting. S&P 500 3-month highs, not very good. S&P 500 3-month lows, of course, increasing. This is just more of the story of the breadth and why some people are concerned about this market really being driven just by those big tech stocks. And as you can see here, why we're concerned is the Mag 7 is priced to perfection. Basically, we're looking at a 37.1 PE versus the rest of the S&P, which is at a 19.6. Very historically high versus, you would say, just a little bit elevated. Here are small caps exhibiting the greatest interest rate sensitivity. So over the last 24 hours, we talked about how the Russell was picking up. Of course, we've discussed this since late last week with focuses on things like TAN and clean energy, etc. And they have been pretty good. But the problem now is that since yields just split and broke through that high, it could be that they actually are in for a little bit more pain first, as the Russell 2000 doesn't exactly love high yields. And this is certainly a big issue compared to the Mag 6. Now, if yields do start to drop though, start to watch that the Russell and the 493, because that's going to be, I think, pretty important. And a lot of it has to do with the 493 other stocks are expected to grow faster than the Mag 7 when it comes to 2024. Something to keep an eye on, and obviously to have price action at the front of your mind for all of these particular markets. S&P 500 net profit margins also coming into focus. Did you know that the only tech, communication services, utilities, industrials, and discretionary sectors are posting actually year-on-year expansions in gross margins? So that's only a cross-section of the amount of sectors out there. There's actually a lot, and many of them aren't doing as well as you might think. Here's another chart of divergences. You can see how the market's generally reacted to this. And of course, we've been detached from that reality because we've been in what we call a positive gamma situation. When we take a look at the markets, there's a lot going on, but really the VIX was something that spiked up. We're not quite through that 1550 level in terms of an overall closure, but you'll notice that the market spiked above there and then came straight back down to it. This is because we have a gamma wall or a call resistance at that level. If that gets taken out, it's probably going to mean that we have a lot of volatility coming in back into the markets. And we'll talk about the S&P 500 level that corresponds with that as well later on in our chart analysis. We already talked about the VIX spiking into the S&P 500 before the CPI. Somebody probably knew about that. And when we talk options, of course, we know that the 4900 to 4920 zone is pretty big. And then we've got some levels just underneath that we'll need to be discussing, including a zone that sits around 4885, which tends to be a switch where we're going to see a market go from positive gamma to negative gamma. And if you know anything about options, that could be a big deal, because if we go from a positive to negative gamma situation, it generally means that volatility is still going to be spiking, but more importantly, it's almost saying we're going to need to move down a bit further. So volatility and the 20 moving average just so happen to be right around these particular zones. Another thing that could tell us whether this is a real sell-off or not is going to be CTAs. Now, unfortunately, I don't have an update for you just yet, but that will be coming over the next 24 hours, so make sure to stay tuned for that. And what that's going to lead into is whether we're seeing CTAs come off their high positions on both NASDAQ and S&P 500. I'd say they probably will, but we haven't seen it yet. So, of course, when we get the news, we'll announce it to you. Now, another thing we've talked about is there's been two things, something around the FOMC and the earnings season tending to lead into a pullback. And of course, when we hit a big 1,000 number, tending to hit into the pullback. Now, we've been talking about the idea of using options. And of course, options are the best way often to short markets, because if they squeeze a little bit higher, you're not necessarily taken out. More importantly, as we hit 5,000, we haven't actually seen any pullback. So that's a pretty big deal, considering in history, we either pulled back earlier, we pulled back right on it, or we pulled back again right on it. So we tend to always see this type of thing occur. Again, it's the time of year that you would hope it happens because it makes sense. China's bounce, this is a totally disconnected market to the rest, but we've talked about it for a little while. Go back and watch our other videos, but I'll just quickly post this through. Thrust's been improving. Obviously, demographics are really bad long term. We can already see here that the market cap of a couple of stocks are outperforming, of course, the Chinese stocks. And we do know that the Chinese stocks tend to go into a relatively bullish time over the next couple of weeks after Lunar New Year. We also know that when they replace their main regulator, that tends to be a bit of a catalyst. So at these lows, some interesting things are going on. As we kind of discussed, Hood was one of the stocks we were looking at. It looks like it had a pretty good after hours response. So that was a nice structural kind of level. Bit of loose lips, you'd have to think, with the rallies that were happening through the sessions, but it was up 10%, I believe, after hours. Some other big earnings announcements coming later on. We've got Crocs, Deere, DraftKings, Cisco, and many more. So make sure to stay on top of that and be warned. There are huge moves on the horizon. Dash, Roku, plus minus 14% on this stock. Don't be caught without knowing the volatility that could be on the horizon. What about Bitcoin? A few people have been asking about this. Generally speaking, Bitcoin is in a very important year because, of course, it is the year of what we see as a halving cycle. If we do tend to get nice rallies after the halving cycle, we often get these huge rallies that come through that April into June period. So Bitcoin's doing well, and certainly it's something we'll be focusing in on after we get through this big volatile time for stocks. ARM couldn't hold up anymore. This stock had been moving 25% per day pretty much, lost 20. But what I noticed most interestingly is even though we fell down and we had 46 million overall options trades, which is big, 54% were still calls and 46% were puts. So that's kind of showing you that there are still a lot of retail traders and a lot of traders in general that are trying to stack the call side. So that could be potentially a trap as well, where we see markets actually start to show price action turning. Everyone's still trying to buy calls, buying the dip, and then all of a sudden it breaks through the key levels that we'll discuss later on. That's going to be a big deal. In terms of rotation, you can see here that solar, clean energy, these very susceptible to yields. Obviously gold, we've talked about it millions of times, how we do not like yields going up for gold. It got absolutely thrashed, down 5%, not good for gold. Dollar index blew through that level we've been discussing. US oil, Brent, they all broke through, discussing those as well. As soon as it happened, you kind of knew those things were going to occur. And it was a good move for currency traders if you're on the right side, but not so good for everybody else. No updates here for central bank liquidity, still kind of just sitting there doing nothing. Yields breached out. Now, this is a big deal because with yields going past 4.2, it kind of opens up the idea that 10 years are going to go to 4.5 and that 2 years also are going to go back up, reaching probably a technical kind of level of around that 4.7%. So that's going to be a big zone there for yields. US 2, US 10, watch those levels. Treasuries didn't like it, and I wouldn't expect them to, so they fell off. Unfortunately, that's what happens. We're still bullish on treasuries over the next 12 months, but we didn't not expect that it could come down. It is possible to get down to the 90 or even 89 level for treasuries, so that's one we'll be watching closely. XHB, if we're talking about home builders, they dropped down. Dow Jones Transportation also dropped down. It is still possible this is part of what we call a Wyckoff distribution, which would be very negative for markets. But of course, no alerts on that just set. Just showing pullbacks generally in the market across the board. The US dollar, though, is the one we want to be watching. So as we know, yields went up. We also expect further yield increases over the next week or 2 weeks. And we know that the dollar index is breached, which is kind of suggesting that we could be moving into the 105.80 zone. Now, it's also an inverse head and shoulders that a lot of people will look at from a pattern, which would suggest even further larger moves. But I think the dollar index breach is a big deal. It's showing that pullbacks are probably going to be met by bull demand. It also shows you that if we get up to this level, that's had usually a correlation with markets falling. So a lot of things could be on the horizon, especially for the S&P 500. US oil, it's up at that key level, 78 a barrel, huge closure zone. If that ends up occurring and we get above 78 closure a barrel, expect oil to blister and it's going to go really, really high. And I would think that we're moving into a territory where oil could even move to 82 to 84 a barrel at that point. Tesla still holding within the range, so obviously not much going on there overall for Tesla, just holding within. Good for credit sellers, not so good for anybody that's trying to take advantage of the market overall, but it is there. Hood giving us a good return afterwards. That, of course, went through and we got that kind of nice high breach. That happened before earnings, and earnings is going to push us back into this resistance. And I would expect some people to take profit there. And it looks like Hood earnings came in a little bit better than average overall. What about ARK K though? Well, its stock was